Stocks on Wall Street completed a choppy trading day Wednesday with a general decline after the Federal Reserve boosted its benchmark interest rate to combat inflation and hinted at future increases. The central bank increased its benchmark short-term rate by 0.50 percentage points as anticipated, making this the seventh increase this year. The Fed also stated that larger rate increases than previously anticipated were anticipated over the next few years. After giving up an earlier gain of 0.9%, the S&P 500 dropped by 0.6%. The Nasdaq composite lost 0.8%, while the Dow Jones Industrial Average dropped by 0.4%. After a small increase following the Fed's decision in the mid-afternoon, bond rates largely decreased. The most recent rate increase by the Fed is smaller than the previous four increases of 0.75 percentage points and comes one day after a positive report revealed that inflation in the United States fell in November for a fifth consecutive month. On Wall Street, recent indications that inflation has eased despite remaining excruciatingly high had fan confidence that the Fed may hint at the potential of rate reduction in the second half of 2019. But Fed Chair Jerome Powell underlined that the full consequences of the central bank's attempts to slow the economy in order to reduce inflation have yet to be fully felt during a press conference after the Fed's most recent policy announcement. In order to ensure that inflation is effectively suppressed, Powell also reaffirmed that the Fed intends to retain rates at a level high enough to slow the economy for some time. He claimed that 2023 rate decreases are not anticipated in the Fed's predictions, which were released on Wednesday. Powell stated that the committee won't lower rates unless it is certain that inflation is declining steadily. He added that it is not as crucial right now how quickly the Fed raises rates. It's much more crucial to consider the highest level, according to Powell. The Fed also made it clear that it anticipates its rate to decline to 4.1% by the end of 2024 and 3.1% by the end of 2025. As stated by Bill Adams, chief economist at Comerica Bank, this is far higher than expectations built into financial markets, which are positioned for the federal funds rate to come back down to 3.9% at the end of 2023 and to 2.6% at the end of 2024. Bond yields fluctuated throughout the most of the afternoon as traders analyzed the Fed's move. Mortgage rates are influenced by the yield on the 10-year Treasury, which decreased from 3.5% late Tuesday to 3.48% today. The two-year yield, which more closely mirrors anticipated Fed actions, remained constant at 4.22%. Along with November retail sales statistics, the U.S. will release its weekly report on unemployment benefits on Thursday. About 70% of the S&P 500 stocks closed lower on Wednesday, with technology firms, banks, and retailers comprising the majority of the benchmark index's constituents. Goldman Sachs sank 2.3%, Best Buy fell 3.9%, and Apple dropped 1.6%. The S&P 500 dropped 24.33 points overall to 3,995.32. The tech-heavy Nasdaq dropped 85.93 points to 11,170.89 and the Dow dropped 142.29 points to 33,966.35. Stocks of small companies also decreased to reach 1,820.45. The Russell 2000 index dropped 11.91 points, or 0.7%. After raising its financial estimate for the fourth quarter and providing an upbeat forecast for 2023, Delta Airlines saw a 2.8% increase.